Hello everyone and welcome to today's session where we discuss AS28 on impairment of assets. Now this is a fairly new standard which is there in your CA Inter syllabus. Earlier this has never been a part of CA Inter. For the first time from May 24, this along with a few other standards were introduced for the first time. So you will not see a lot of RTPs, MTPs or past exam questions before May 24 for this chapter. Nevertheless, we will do a few extra questions from, let us say, a few sources from CA final as well. Apart from that, we will discuss every question which is there in the study material as well, including illustrations, practice questions as well as examples, so that you have a complete coverage. So you have AS28 which is impairment, AS28 which is on impairment of assets. What does the word impairment refer to? Impairment refers to the reduction in the carrying value of the asset or reduction in the earning capacity of the asset. Now usually when you record assets like a PP or like an intangible, you will record them at historical cost and then you will depreciate it and record them using the cost model. In certain cases, revaluation model can be followed, let us say for PP, but by and large we follow the cost model. So when you measure this PP or intangibles, the problem over here is you don't really compare this with any value like inventory. You compare carrying value or the cost or NRV, whichever is lower. Now in case of a PP or an intangible, you really don't do that, and as a result it is very much possible that you have an asset which is not capable of giving you as much benefits. However, you are still depreciating, amortizing it over the life, and hence the standard over here believes that an asset inherently is defined as a resource controlled by the entity due to past events which is capable of generating future economic benefits. So over here, if the asset is generating benefits which are lower, then what do we do? Well, you test it for impairment. When do you test for impairment? We will see, but first, what is impairment testing? You will compare the carrying value, that is the ledger balance of the asset, with something called as the recoverable value. Now what is recoverable value? Well, for inventory we usually calculate NRV, right? Because well, inventory is held for the purpose of sale, and hence we need to figure out how much is the value that an inventory will get if it is sold. However, a fixed asset or an intangible is generally held for the purpose of use. So we want to calculate something called as value in use, which is calculated as the present value of future cash inflows. So you will try to predict the future cash inflows. Like for example, you have a car which has a carrying value of 100 rupees, and let us say the remaining life over here of this car is, let's say, another let's say 10 years. Now I want to figure out whether this car is impaired or not. So I will figure out that what can I do with the car? Well, I can sell the car today. If I sell the car today itself, I can't use it. But if I sell the car today, I will get the fair value. That is the net selling price, which is the fair value minus the disposal cost. So let us say the fair value of the car today is, for example, 75. And if I dispose it, there will be a cost, incremental cost like brokerage, etc. of 5. And hence the net selling price is, for example, 70 rupees. So will I say that the car can recover only 70? No, I can either sell the car or I can use it. And if I were to use the car, let us say I will generate some cash flows in the form of cab rentals. From that I will subtract the expenses like driver salary, fuel expenses, toll charges, commission paid to platforms, etc. and I will get a cash inflow. Now this cash inflow, for example, can be 15 rupees per annum. However, let us say the life of the car is 10 years. Can I do 15 into 10? No. 15 in the first year is not equal to 15 in the 10th year. And hence I will calculate, let us say, the present value. There can be an annuity factor which may be given, or you can sit and calculate it, or you can do the working by discounting each year's cash flows. Let us say the rate is 10% for a period of 10 years. For example, this is coming to 6.145 for example, and hence this comes to, let's say, something like 92. The present value of future cash flows comes to 92.15 or something, let us say. So recoverable value is the value that an asset can recover. Now how much can the asset recover? Well, either 70 or 92, not both of them. It is mutually exclusive. Like if I use the asset, I can't sell it immediately. If I sell the asset now, I can't use it, and hence the recoverable value is the higher. Remember, you have to consciously remember what is the asset capable of giving. Well, 92. Recoverable value is higher of the two, which is 92, which means if I were to look at the impairment, I will say that the asset has an 8 rupees impairment. Well, why? Do the best thing you can. Still the asset can throw back only 92 at you. However, in your books you are telling the world that the asset is worth 100. A reader is entitled to believe that the asset is a resource capable of giving future economic benefits. So we will assume that if the asset is shown at 100, it can at least give me a benefit of 100. In this case, it can't give me a benefit of 100. At max, it can give me a benefit of 92 rupees. And as a result, I can say 100 minus 92, which is equal to 8 rupees, which will be treated as my impairment. And where will the impairment go? So it will be taken to the profit and loss account. Now this is generally taken to the profit and loss account. This is 100 minus 92, which is equal to 8. Remember, impairment is a one side standard. Like if instead of 15 this was 20 rupees, if I do 20 into 6.145, let us say it comes around 120, 125, or let's say 130. 100 with 130, well, I will say that the asset is capable of giving me more than what is there in my ledger balance. It is not impaired. So when I look at an impairment, where will the impairment loss be recorded? Well, in the profit and loss account initially. However, if the asset was subjected to revaluation and there is a balance in the revaluation reserve, like for example, there is a 5 rupee balance in the revaluation reserve of this car, then I will say that out of the 8 rupees of impairment, I will first adjust the 5 rupees from the revaluation, and excess if any will go to the P&L. It is like subsequent downward revaluation, in which case you first adjust from the balance in the revaluation reserve, and excess if any will go to the P&L. Now sometimes the student also wonders that what is the difference between downward revaluation and impairment? Remember, downward revaluation is to be done at sufficient intervals for a class of PP. Impairment is to be done, as you will study, only for the category of asset where there is an indicator of impairment. Downward revaluation is to be done only if you are following a revaluation model. Impairment can be done irrespective of whether you are following a cost or revaluation model if there is an indicator of impairment. Now, the treatment of impairment loss, first we adjust it against the balance in revaluation, and excess if any will be taken against the P&L account. Remember, impairment refers to the reduction in the carrying value of the asset, and hence impairment cannot take the asset at a value less than 0. Like for example, the asset is appearing at 100 and the recoverable value, for example, is 0 rupees. Which means the entire 100 is my impairment loss. However, this is an asset which needs to be destroyed, disposed of, and hence there may be an other cost of 10 rupees. No one is going to give me anything, I can't even use it, and hence the recoverable value is 0. However, there is still a 2 rupee cost or a 10 rupee cost which is to be incurred in order to dispose of the asset. That will go to the P&L account separately. You cannot say that the impairment loss is 100 plus 10. Well, impairment loss is 100, there may be a further 10 rupee cost. Impairment is defined as the reduction in the carrying value of the asset, so that is the value that can get the asset down to a 0 balance. Now, why do I need a separate accounting standard? Like inventory, within AS2 only they mention that inventory can be recorded at the lower of cost or NRV. In a similar way, this could have been mentioned in AS10 or AS26 that you show the intangible or tangible asset at the carrying value or recoverable value, whichever is lower. Now, the problem over here is inventory, the NRV is much more easier to find because you are selling inventory in the ordinary course of business. But the problem is when it comes to impairment, well, you don't sell the fixed asset in the ordinary course of business, and hence the net selling price may not be as easily determinable. Further, the recoverable value using value in use, that is the present value of future cash flows, is even more complex because I have to predict the cash flow for each machine. Imagine a company like Tata Steel which is in operation for close to 100 years. The cash inflow for each of the machines very difficult to calculate, or rather very time consuming, and hence the standard puts a relaxation over here. It says that impairment testing, that is determination of recoverable value, is only to be done if there are indicators of impairment, and that indicators can be external or it can be internal. Remember, for inventory cost or NRV, whichever is lower at each balance sheet date. For AS10 PP revaluation model, if you follow, that has to be done at sufficient intervals, but impairment has to be done only if there are indicators, and indicators can be external. For example, entry of a strong competitor like Jio, or legal ban like government banning tobacco, or let us say introduction of a new technology like for example Kodak was manufacturing photo films and now you have a technology which is digital photography, in which case there is an indicator of impairment based on external factors or a COVID-19 lockdown. Internal factors can be continued cash losses or a physical damage on the asset. If something like this happens and the management believes that there seems to be an indicator whereby I think the recoverable capacity of the asset is falling, and hence I can test for impairment, that is determine recoverable value. This is highly subjective, and yes, the management, if it wants, it can always say that I don't think there's an indicator, in which case impairment testing may not necessarily be required. So over here, in my opinion, this is one of the most important parts of this standard. Now, apart from that, there are a few other parts as well. We will discuss that, but mostly whatever questions should come will come from this first page that you see over here. Most of the institute's questions are geared around that page only. Now, there is a possibility of additional adjustments in value in use. Value in use is the present value of future cash flows. While calculating cash flows, remember we do it before interest and before tax. Even the discount rate is like the WACC, which is before interest and before tax. While calculating value in use, if there is inflation, you will definitely take inflation into the calculation, and most importantly, what the institute asks, if there is salvage value, then that salvage value will also be taken into the calculation of value in use. Now, there might be a special adjustment for site restoration. There may be a possibility where the company has an asset which is subjected to a site restoration obligation as per AS10 and AS26. So, your asset has a construction cost of 90 plus 20 rupees site restoration obligation. Your asset is entries asset account debit to the provision for site restoration, and hence this is 110. So I will show my PP at 110, and there will be a provision in my books for a dismantling obligation at 110. Now there might be a buyer who is quoting me a net selling price of 90 rupees. Now if I compare 110 with 90, it appears to be 20 rupees impairment. However, that is wrong. Remember, the buyer, when he acquires the asset, he also acquires the site restoration obligation along with it, and hence the buyer is quoting you 90 not just for the asset, he is quoting you asset and liability both. So if you have done amalgamation, if you have not done, no problem, but if you have done amalgamation, remember, when you calculate goodwill under amalgamation, you compare the purchase consideration or PC with the net assets, that is asset minus liability, because you take over asset and liability both. In a similar way, over here, this 90 is to be compared with the carrying value, which is 110 for the asset, along with 20 of liability, which they take over, and hence 110 minus 20, that is equal to 90. For something worth 90, the buyer is paying 90, there is no impairment. Further, when I even look at value in use, it is a present value of future cash flows, and when I calculate future cash flows, I will take all cash flows, like I add the salvage value, because that gives me a cash inflow. In a similar way, if after 10 years I have to dismantle, that will be a cash outflow. So my value in use should also be after considering the site restoration obligation. My net selling price should also be ideally after my site restoration obligation, and hence I'll compare it with the carrying value, which is also after the site restoration obligation. Not very important, but there's an example in the institute study material pertaining to this, which we will discuss, and hence we are just kind of touching upon that. Now, when there is a reversal of impairment, I would say this is not very important, but nevertheless, if you have to do, you have to remember that while reversing impairment loss, which has already been recorded, you will not reverse the loss beyond the carrying value had there been no impairment, or recoverable value, whichever is lower. So we will first say that had there been no impairment, then what will be the carrying value? Compare that with the recoverable value, because you cannot reverse impairment beyond that. So lower of the two is the maximum value. Compare it with the actual ledger balance, and then the reversal is calculated as a difference. So institute has not really asked you many sums. In fact, you will not even see a single sum on the numerical side on reversal in your main direct material, but nevertheless, if it comes, we will do a couple of additional questions from other, let's say, finals year related material as well, so that you get a clarity on the numerical side as well. So this is regarding reversal. Remember, you can reverse impairment on all assets. However, for goodwill, reversal can happen only if the reversal is due to certain external factor like a legal ban, and that same external factor is kind of lifted. Only then can a reversal of impairment happen. Otherwise, you cannot reverse impairment on goodwill. So why? Because it might create a self-generated goodwill, and self-generated goodwill as per AS 26 cannot be recorded. Now this is the first part of your standard AS 28. Second part is on a concept of cash generating unit or CGU. Now what do you mean by cash generating unit? Well, sometimes what might happen is an individual asset may not be capable of generating a largely independent cash flow. Like for example, you might have a car. A car is capable of generating usually an independent cash flow. However, if you have a machine as a part of an assembly line, like a line of machines which are working together to manufacture one output, like for example, you have 4 machines A, B, C, D, which are working together to make a bottle of Pepsi. Now the problem is there's an indicator of impairment in machine C. Now machine A makes the drink, machine B makes the bottles, machine C pours the drink into the bottles, machine D puts the caps and the labels, etc. Now all of them work together to make a bottle of Pepsi. During the year, 1000 bottles of Pepsi are made, and you can find the cash inflows for the entire group of assets. A, B, C, D are working together to generate a cash flow. However, only C does not generate a largely independent cash flow. C is working along with A, B and D in order to generate a bottle of Pepsi, and hence if there is an indicator of impairment on machine C, it is possible that you can find the net selling price of machine C. However, you also want to find the value in use. Now the problem is the value in use for machine C is not reliably determinable, and hence if the value in use for machine C is not reliably determinable, it becomes a little challenging on how do you calculate the value in use. Well, you can't calculate it because you can calculate it not for C alone, but you can calculate for A, B, C, D. That is the smallest group of assets, that is A, B, C, D, which are capable of generating a largely independent cash flow. Now there may be other factories where you have machine E, F, G, H. However, if there's a problem in A, B, C, D, that's a problem in A, B, C, D. E, F, G, H does not have a problem. So you look at the smallest group first. Cash generating unit is the smallest group of assets which are capable of generating a largely independent cash flow. There may be 100 other machines in the company, but these 4 machines can generate a largely independent cash flow. Second, it has to be capable of generating, like sometimes what might happen is a company might have a mine which is generating iron ore, and there's a steel refinery which is using that iron ore. So it might appear that the steel refinery is entirely dependent on the mine is entirely dependent on the iron ore. However, iron ore, mine is entirely dependent on the refinery. However, the iron ore is something which has an active market. So even if the steel refinery is not there, I can sell the iron ore in the market and generate a cash flow. So the mine is capable of generating a largely independent cash flow even if the refinery is not there. Further, refinery can buy the iron ore from an independent market even if the mine is not there, and hence there are two separate cash generating units. Now the problem always arises that why am I going to the cash generating unit level? Remember, cash generating unit you go if the asset where the impairment indicator exists is not capable of generating a largely independent cash flow. If the asset itself is capable of generating a largely independent cash flow, then for the asset itself I'll find the carrying value. For the asset itself I'll find the recoverable value. But in the assembly line case, like for machine C, which just puts the drink into the bottle, it is not capable of generating a largely independent cash flow. So I can't find its value in use. I can't predict its cash inflows, for example, and hence one cannot say that for machine C, I just compare the carrying value with, let us say, the net selling price. Machine C is being used, and hence I want to figure out whether the machine is impaired. If I can't find the recoverable value for machine C, that is the best thing. Then the next best thing, that is, I will look at it for the CGU as a whole. So whenever the assets where indicators of impairment exist are not capable of generating a largely independent cash flow, that is when I will go to the next level, that is a CGU level, and try to check for impairment at the level of the CGU. So I hope this understanding is clear over here. So this is the concept of CGU. Now let us say that your CGU comprises of 4 assets with a carrying value of 10, 20, 30 and 40. Okay. Apart from that, there can also be other assets which can be allocated to the CGU, like there can be an allocable goodwill. Like for example, you might have acquired, like Coca-Cola a few years back acquired Pepsi, acquired Thumbs Up and Gold Spot. Now Gold Spot, later Coca-Cola closed, so there was an indicator of impairment on Gold Spot, and hence the machineries A, B, C, D which manufactured Gold Spot, there was a problem. However, there may be some goodwill that we might have paid to acquisition of Gold Spot. Now if this operation is impaired, even the goodwill which is attributable to Gold Spot should be a part of the carrying value of the CGU. So what is the carrying value of the CGU? Include the carrying value of the individual assets in the CGU, that is A, B, C, D, along with the carrying value of the allocable goodwill. If the goodwill is allocable, then we will do this working. If it is unallocable, we will see what is to be done. Like if the goodwill is allocable, we will find the total carrying value of the entire cash generating unit as the carrying value of the individual assets plus allocable goodwill. Sometimes there may be allocable corporate assets as well. Now what are corporate assets? Like a research and development center, or like a training center, or like a head office. Like for example, Maggi was banned a few years back. Now Maggi is manufactured by Nestle. Now Maggi has 3, let us say, assets A, B and C which manufactures the Maggi. Like for example, machine A makes those noodles, machine B makes the masala, machine C makes the packet and assembles all of them. So that is ABC working together to make Maggi. Also, let us say Maggi was acquired by Nestle from an Italian company for which they gave goodwill, and hence allocable goodwill also you will add if applicable. And further, there may be a corporate asset, like there may be a research and development center which is trying to do some research and try to give various suggestions. Like they see that people are becoming health conscious, so they say let us make atta Maggi, and they give you the formula for atta Maggi, or they want to have a different type of a masala and so on. So remember, if Maggi cannot be manufactured, ABC become kind of useless, but so does the corporate asset which was doing a research and development on Maggi. And hence when you calculate the CGU, your CGU comprises of the carrying value. So step 1, if you want to calculate the impairment loss in case of a cash generating unit, step number 1, calculate the carrying value of the CGU, that is carrying value of individual assets like ABC plus allocable goodwill, okay, plus the allocable corporate asset, let's say corporate asset D, which is a research and development center, that is going to give you the carrying value of the entire CGU, that is 150. Step 2, compare it with the recoverable value. Recoverable value over here would be the value in use or net selling price of the entire CGU, whichever is higher. So over here, let's say this is net selling price of the entire CGU 80, value in use which is 90, select whichever is higher, which is 90 rupees, okay. Which means you compare 150 with 90, and hence the impairment is 60 rupees. Where does the impairment loss go? Well, ideally to the P&L account. However, impairment loss into bracket P&L to what? Well, we will first credit goodwill, that is 50. Why? Because you cannot separate out and sell goodwill. The worst case A, B, C or even D, you can separate out and sell it. Goodwill is something which can't be just separated out and sold, and hence the standard says first you will write off goodwill, that is 50, and then against other assets. Other assets including corporate assets will go another 10. Now this 10 will be allocated to whom? Ideally between A, B, C, D in the ratio of their carrying values. However, if you go to C, if you allocate something to A any amount, let's say 10 minus even 1 rupee is allocated to A will become 10 minus 1, that is equal to 9. However, A can prove that it is not impaired. It has a net selling price of 20. Even if the value in use cannot be determined, A can prove that I can recover back 20 and hence I am not impaired. So A will not bear any impairment loss. Further, B can also prove that it will not impair. It is giving you exactly 20. However, it can prove that it will not bear any impairment loss. But if you go to C and D, they can't prove that. And hence, this will be allocated to C and D in the ratio of their carrying value. So 10 into 30 divided by 70 and 10 into 40 divided by 70, and that will give you your impairment loss. So the law says you will allocate the impairment loss first against goodwill, allocable goodwill if any, second excess loss if any, should be written off against all other individual assets, including corporate assets, in the ratio of their carrying values. So ideally it should go to A, B, C, D in the ratio of their carrying values, but the allocation should ensure that the carrying values of the individual assets or corporate assets should not fall below the individual recoverable value, that is individual net selling price or individual value in use, whichever is higher if available. So this is regarding the allocation of impairment loss. It's quite complicated. Institute has asked you stuff at final CA over here, but at CA Inter, most of the places, Institute has not gone into this. The most of the sums that we see are still pertaining to page 1 only. So then why are we doing all of these? Because if you read the theory in your CA Inter material, everything has been explained. But because you are at an Inter CA level where you expect a working knowledge, they have not asked you questions. But you never know what if they ask you in the exam. So it is best if you have a broad working knowledge for even these complex concepts. Though for the first page, for this first area, you have to have detailed expert level knowledge. For other things, have a broad understanding just in case something lands up, and if you have to attempt, you should be in a position to attempt. But at a CA Inter level, this is a little higher level, I would say. So over here, this is an example. If you want, you can pause and view this example as well. Read the explanation over here, and then it continues like we discussed over here, that out of the 60, you will first take 50 to goodwill, and then other assets, technically A, B, C, D. However, A and B can prove that they can recover back the 10 and 20 which is there in your ledger, and hence the loss will have to be borne by C and D, who cannot prove that, and hence your entry will be impairment loss, which will go to the P&L, to goodwill, to C, to D. Reversal for impairment loss of a CGU will have the same pattern as the individual assets. That is, you will reverse in such a way that you cannot take the ledger balance below the individual carrying value had there been no impairment, or recoverable value, whichever is lower. Okay. Appropriate allocation in case of allocable corporate assets. If you have to allocate a corporate asset like a research and development center to each of the divisions or each of the assets within the divisions, then in what ratio will you do that? Well, usually in the ratio of the carrying values. However, sometimes what might happen is you might be given the ratio of the carrying values. Let's say carrying value is given for A, B, C, and this is given as 10 to, or let's say 100, 200 and 300. Now there is a corporate asset D which is worth 500 rupees, or not 500 rupees, let's say it is worth 50 rupees. I need to allocate this 50 to A, B and C. Now ideally I will allocate the 50 in the ratio of 1:2:3, or let's say this is worth 60, let us say. So ideally I will allocate in the ratio of the carrying values. The bigger the division, the more the utilization. However, if you are also given the life, let's say the life over here is 30, over here is 20, over here is 10. In which case you will say that, well, the longer the life, the more the utilization, the shorter the life, less the utilization. Again, within that, bigger the size of the department or company, more is the utilization. And hence, what institute does is, if the life is given, then it will take a product of the two, and this will be 3000, this will be 4000, this will be 3000. And you will allocate. For simplicity, okay, let me just change it so that it is easier. Let's say this is 70. Then this 70 will be allocated to A, B and C in the ratio of 3:4:3. Okay, let me just keep it as 60 only. I mean 60, 70 kuch bhi chalega, with 3:4:3 is I think 10. So I will say 100, 200 and 300. On which I will add the allocable corporate asset of 60 into 3 by 10, that is equal to I think 18, 24 and 18, and this will be your total carrying value including the allocable corporate asset. So over here we have been told that if nothing is given, you will take the carrying value, otherwise it will be based on the time based weighted average carrying value. So again, these are slightly complex concepts. Institute has not given you sums on this, but they have given you theory on this, and hence if there is any unallocable corporate asset, or for that matter if there is any unallocable goodwill as well, then what will we do? We will, like we said, that for an individual asset, ideally you should do impairment testing. You can't do that, then you go to the slightly higher level, that is a CGU. Now the problem is, Tata might acquire a particular company like JLR, but it cannot reasonably allocate how much of the goodwill is towards Jaguar and how much of the goodwill is towards Land Rover. And as a result, well, it has paid a goodwill of 100, but it does not know how much of the goodwill is attributable to Jaguar, how much of it is attributable to Land Rover. So I will, if there's an indicator of impairment in Land Rover, I will try to do impairment testing for Land Rover, but I can't allocate the goodwill. Okay, so I'll try to do the impairment testing, and then if I can't allocate the goodwill even to that Land Rover CGU, then I will go to the larger CGU like JLR Limited, Jaguar Land Rover Limited, to which the goodwill can be allocated. Like if I can't do impairment testing on an individual asset, I go to the larger, that is the CGU level. But if I can't even allocate goodwill to the CGU, then I will go to a larger level for goodwill testing, and over there I will do the impairment testing for the goodwill. So over here the steps would be, I will first do the impairment testing for the smaller CGU, and if goodwill or corporate asset cannot be allocated to the smaller CGU, then I will go to the larger CGU as a separate working, that is the company as a whole, and try to do impairment testing for the company as a whole and see if there is any impairment. So step number 1 will be to calculate the impairment loss for the smaller CGU. Second, if there is any impairment loss, calculate the revised carrying value. Third, you will allocate these unallocable corporate assets or unallocable goodwill to the larger CGU, and then do impairment testing for the larger CGU. Impairment loss is calculated for the larger CGU. The loss, if any, is to be borne by the unallocable assets as a smaller CGUs, including your allocable corporate assets, if any, are at your lower of carrying value or recoverable level, because you have already done impairment testing for the smaller CGU. Highly complex, best if you understand it with numbers. So we are just touching upon the theory right now of things which are relatively lesser important. We'll do the numbers where you get a better clarity for this. However, having said that, this has relatively lesser possibility to just touch upon it and proceed. The first part is the most important part. And we have mentioned over here for PP along with site restoration obligation as well. So special case is given for this. So this takes care of AS28. If I go to the questions pertaining to AS28, so in our material you have, for last day revision we have marked these questions. So if I just run you through the 19 questions that are there in the material, out of the 19 questions, question 1 se leke question number 10 are from the institute illustrations and institute practice questions. So this is something which are inherently from the institute. From 11 to around 15 we have taken examples which are there from again the institute study material only. So from question 1 to 15 I would say these are questions in your CA inter material. Then from 16 to I think 19 hai, not 20, from 16 to around 19 you have questions which we have taken from your RTPs of final CA for AS28 to cover slightly more complex concepts for whom theory is there in your study material but sums are not there. So if you find it difficult, you can even skip question 16 to 19 because the institute has not asked you at CA inter level. But if you want a better understanding, just do it once and for all and have a very clear understanding, because theory to aapko padhna padega, sums ke sath karenge, you will understand it better is my reading. Okay, within that the important questions from your last day revision we have mentioned from the first 15 questions only, the other questions are just for a understanding level. Okay, so let us review question number 1. Definitely something that you should do for your last day revision. Ergo Industries Limited gives the following estimates of cash flows relating to PP for the year 31st December 11. The discount rate is 15% and you have these cash flows. Then you have the residual value at the end of 2016 also. That is also a cash inflow. So basically at 2016 you will receive 4,000 plus you will also receive a residual value of 1,000 lakhs. Property, plant and equipment purchase, there is a small change over here. This is on 1st of January 2009 for 40,000. Useful life. Net selling price is given. This is on 31st December 11. You are required to calculate the carrying amount at the end of 2011. So over here, you have purchased the asset at 40,000. on 1st January 2009. Today you are sitting on 31st December 2011, that is 3 years away. So this is minus 40,000 divided by the total useful life is 8 years, out of which 3 years have gone by. 40,000 divided by 8, no sorry, there is some salvage value as well. So salvage value over here is 1,000. So 40,000 minus 1, that is 39,000 divided by 8 into 3. So this is coming to 14,625. So basically 14,625 and 40,000 comes to around 25,375. So this is your carrying value, 25,375. Okay, value in use as on 31st December 11. This is calculated as the present value of the future cash flows. You will discount this at the rate of 15%. 1 divided by 1.15, let's say 0.86, 96, 7561 and so on, 65, 0.57, 0.4 karke you will find the present value. So over here 1 divided by 1.15, 1, 2, 3, 6, 5, 7, 5, 5, 7, 1, 8, 4, 9, 7, 2. So you will multiply 4,000 with 0.8696 m plus 6,000 with 0.7561 m plus 6,000 into 0.6575 m plus 8,000 into 0.5718 m plus and 5,000 at the end into 0.4972 m plus. I'll take it up to 4 decimals. Having said that, you can even take it up to 3 decimals and you will get around 19,024 or 25 as the case may be. As you can see, 19,025. Maybe a little bit of rounding off here and there will work. Here 3 decimals are taken, we are taken 4 decimals, so 19,020 aata hai. But nevertheless, if I keep the same working, this is 19,025 approximately. This is value in use, present value, future cash flows. The important thing over here is you should also take the residual value. Next is the recoverable amount on 31st December. Now recoverable amount is comparing the net selling price, that is 20,000, and the value in use, selecting whichever is higher, that is 20,000. So your recoverable value is 20,000. Impairment loss to be recognized. The impairment loss is carrying value, that is 25,375 minus the recoverable value, which is 20,000, and hence you will have 5,375, which is your impairment loss. Revised carrying amount is to be calculated. How do you calculate the revised carrying value? The revised carrying value is calculated as 25,375 minus 5,375, which equals 20,000 after impairment, and lastly depreciation for the year 2012. Now for 2012 you have 20,000 which is there in your ledger minus 1,000, assuming that is the same salvage value. Out of the useful life of 8 years, 3 years are over and hence 5 years are remaining. So this is 19,000 divided by 5 comes to around 3,800 per annum. So this is a question which kind of covers almost every aspect, and institute would love to ask you a question like this if given a chance. Depreciation, impairment, recoverable value, net selling price, value in use, carrying value, everything is tested over here. Definitely something that you should revise for your last day. Now question 2 is a subset, a smaller version I would say of question 1. So if you have done question 1, question 2 kind of is a sail through. X is having a plant with a carrying amount of 100 lakhs on 31st March 11. Its balance useful life is 5 years and residual value at the end of 5 years is 5 lakhs. Okay. Estimated future cash flows from the using of plant or the next 5 years are given to you. You are required to calculate the value in use for the plant if the discount rate is 10%. So over here, if I look at my cash flows, in the last year, there will be a salvage value of another 5 lakhs which is added. So this is 25. Other than that, I will try to find the present value, discounting at the rate of 10%, 0.90918264 and so on, and hence you will find the present value. 50 into 0.9091 plus 30 into 0.8264 karte you will find the value in use, which is around 121.92. Institute takes 3 decimals. If you want, you can take 3 decimals. I prefer taking 4 decimals. Let us say this comes to 121.92. Also calculate the recoverable amount if the net selling price is 60 lakhs. So if you take 121.92 or 60 lakhs, you will select whichever is higher, which is 60 lakhs, and hence the recoverable value is 121.92. And if I had to calculate impairment, 100 lakhs with 121, there is no impairment loss if it was asked. That is question number 2. Now question number 3 I would say is important because it tests for recoverable value in the revaluation model, impairment, everything over here. So this is interesting. Now G acquired a machine on 1st April 10 for 7 crores and an estimated life of 7 years. So that is approximately 1 crore per annum of depreciation had there been no residual value. The machine is depreciated on a straight line basis and does not carry any residual value. Perfect. That is 1 crore each year. On 1st April 14, so that is 4 years later. So the depreciation must be 4 crores, so 7 crores on 1st April 14. Your ledger balance will be 7 minus 4, that is 3 crores still appearing in your books. The carrying value of the machine was reassessed to 5.1 crores. That means there is an upward revaluation. So 3 plus 2.1, that will come to 5.1. So there is an upward revaluation where 2.1 will go to the revaluation reserve. Your ledger balance will be 5.1. And the surplus arising out of revaluation is credited to the revaluation reserve. Even if not given, we would have taken that. Upward revaluation AS10. For the year ended March 16, that is another 2 years later, there will be a further depreciation. Conditions indicating an impairment of machine existed and the recoverable amount is ascertained to be 79 lakhs. So over here there will be a depreciation for 2 years. How much will that be? Well, 5.1. Well, out of the 7 years, 4 years were done, 3 years were remaining. So 5.1 divided by 3 into 2. So that is around 3.4. And as a result, in your ledger, you will see 1.7 still appearing in your books. And the recoverable amount is 79 lakhs. So this is 1.7 or 0.79, whichever is lower. So 0.79 and hence 1.7 minus 0.79 will come to 0.91, which is your impairment loss, which will go ideally to the P&L account. However, if there is a balance in the revaluation reserve, it will first be adjusted against whatever is the balance in the revaluation reserve and only excess will go to the P&L. आगे देखते हैं, you are required to calculate the loss of impairment on the machine, that is 0.91, and show how this loss is to be treated in the books of G. G had followed the policy of writing down the revaluation surplus by the increased charge of depreciation resulting from revaluation. So it has decided to kind of adjust the excess depreciation, or it has decided to write off the impairment loss, write off the revaluation reserve in the ratio of depreciation simplistically. So over here we can say 2.1 is the revaluation balance. This 2.1 should be spread over the remaining 3 years, out of which 2 years are done, and hence 1.4 should be written off, and hence the balance in the revaluation reserve is 0.7. So out of the total impairment loss of 0.91, 0.7 will be adjusted against the revaluation surplus, and the remaining 0.21 will be adjusted against the P&L account. So over here, if I go to C, I can compare 1.7 with 0.79 and see 0.91 is my impairment loss. Out of the 2.1, I will say that I will adjust whatever is remaining 0.7 from the revaluation, and hence 0.21 will go to the P&L. So this is a question where institute kind of helps you practice both the AS10 revaluation adjustment. Remember, it is not mandatory for you to transfer the balance in the revaluation reserve in the ratio of depreciation, but the question very clearly tells you that you have decided to transfer that, so we will do that. Okay, next is question number 4. X purchased a PP 4 years ago at 150 lakhs and depreciates it at 10% per annum on an SLM basis, that is 15 per annum. At the end of the 4th year, acha, 4th year means how many years have gone by? 4 years. So 15 into 4, 60 must be the depreciation already recorded. 150 minus 60, 90 must be the ledger balance. It has revalued the asset at 75 lakhs. So there's a downward revaluation. So in my books, my asset must be 150 minus 60, that is equal to 90, but the downward revaluation fair value is 75. So 15 rupees will go to the P&L account as downward revaluation. 15 will go to the P&L, asset will come to 75, and has written off the loss on the revaluation to the P&L, which is correct. It has already done that, no problem in that. However, on the date of revaluation, the market price is 67.5 and expected disposal cost are 3 lakhs. So net selling price will be 64.5, 67.5 minus 3. What will be the treatment in respect of impairment loss on the basis that the fair value for revaluation purpose is determined by market value and the value in use is estimated at 60 lakhs. Now, how that 75 was calculated, we don't know, but however it was calculated, it is done. Your ledger shows the 75 balance and you have already taken the 15 to the P&L. Now, if I have to compare the carrying value, which is 75 in my books, with the recoverable value, which is the higher of these two, which is 64.5, then there will be an additional 10.5, that is 75 minus 64.5, that additional 10.5 will be taken to the profit and loss account. So over here, this is, let us say, the impairment loss of 10.5 should be recorded as an expense in the statement of the profit and loss. So this is question number 4. Next you have question number 5. This is on the concept of a cash generating unit. Remember, cash generating unit is a group of assets, rather smallest group of assets, which are capable of generating a largely independent cash flow. So if you can generate an independent cash flow, then you don't need to add other assets. You can do impairment testing directly for that. So a publisher like Bennett Coleman, who manufactures Times of India, owns 150 magazine titles, out of which 70 were purchased, like they acquire midday. So they must have paid a consideration. I can determine the cost, and 80 was self-generated, like for example Times of India or Economic Times, whose cost may not be reliably determinable, and hence as per AS 26, you don't recognize a self-generated asset because you don't know the cost that has gone behind. The price paid for a purchased magazine is recognized as an intangible asset, which is correct because I can determine the cost reliably. The cost of creating a magazine title, self-generated, and maintaining the existing titles is recognized as an expense because cost is not reliably measurable. Again, this is correct. Cash inflows from direct sales and advertising are identifiable for each magazine. Perfect. Which means for each title, like Economic Times, I can clearly identify what is the direct sales of those newspapers or magazines as well as what is the advertising income. So Economic Times alone is capable of generating a largely independent cash flow. Similarly, Times of India, Mumbai Mirror, Bombay Times, etc. All of these are capable of generating a largely independent cash flow. Okay. Titles are managed by customer segment, like Mumbai Mirror is for, let us say, let's say Times of India is for the general segment, Economic Times is for the financial segment, etc. The level of advertisement income of a magazine depends on the range of titles in the customer segment to which the magazine title relates. So, if for example you are catering to a financial segment, your advertising income might be higher, for example. The management lays a policy to abandon old titles at the end of their economic lives and replace them immediately with new titles with the same customer segment. Like earlier, you had Midday, which was a purchase brand, which they discontinued, and now you have Mumbai Mirror. So there may be an indicator of impairment on Midday. What is the cash generating unit for an individual magazine title? Well, is the individual magazine capable of generating a largely independent cash flow? The answer is yes. This sentence which says that cash flows from direct sales and advertising are identifiable for each magazine title, and hence they are not highly interrelated with the other titles, and hence the individual magazine itself is capable of generating a largely independent cash flow. I don't have to club the 80 or 70 magazine titles. The individual titles can be tested for impairment as per AS 28. Next, you go to question number 6. An asset does not meet the requirements of environmental laws which have been recently enacted. Okay. The asset has to be destroyed as per law. If it is destroyed, it cannot be used. The asset is carried in the balance sheet at the year end at 6 lakhs. So, if I look at my carrying value, the carrying value is 6 lakhs. If I look at the recoverable value is the net selling price or value in use. If it has to be destroyed, value in use is 0. The estimated cost of destroying the asset is 70,000. So, what Institute has done, and maybe you can do it differently as well, is they have said that the net selling price will be 0 because the asset has to be destroyed. You can't sell it, you can't use it. But if I have to destroy it, there should be a 2 rupee cost, and hence this is -2 or 0, whichever is higher, which is equal to 0, and hence 6 rupees will be the impairment loss. Now, what do you do with 2 rupees? In my opinion, 2 rupees will also go to the P&L as destruction cost as per AS 29. Because there is an obligation to destroy. So I can always compare directly my carrying value of 6 lakhs with the recoverable value, which is 0, and hence book a 6 lakh impairment loss. Beyond that, there will be no loss. If there's a further, not 2 cancer, I'm sorry, this is 70,000. So this is, if there's a further 0.7 cost, this will be recorded as per AS 29. So if there is uncertainty, you give a disclosure. If there is certainty, or if it is probable, you will create a provision. So over here we will say the asset will be fully impaired and impairment loss of 6 lakhs has to be recorded. Further 70,000 if required will be recorded separately in the P&L. Okay, next is question number 7. Venus has a fixed asset which is carried in the balance sheet at 500 lakhs. As on that date, the value in use is 400, net selling price is 375. So the recoverable value will be 400. From the above data, calculate impairment loss, which is 500 minus 400, which is equal to 100. Journal entries for adjustment of impairment loss. I will usually say impairment loss account debit, which will be taken to the P&L ultimately. To what? Well, I will credit the PP or fixed asset. Now, if you are following a provision for depreciation or provision or of impairment method, then instead of crediting the fixed asset, you will create a provision for accumulated depreciation or accumulated impairment, like what the institute has done over here. Having said that, you have nowhere been told that you are following the provision for depreciation method, and hence alternatively, instead of crediting a provision for accumulated impairment loss, you can also credit the property, plant and equipment and directly show the asset at 500 minus 100, that is equal to net 400. Here you are creating a provision of 100, and hence in the balance sheet 500 minus 100 at 400 it will still appear. Show how the impairment loss will be shown in the balance sheet. Well, 500 In my opinion, less 100. Directly we will show 400. Not really important. Achha, question number 8 is on CGU level impairment, whether required. This is important. I would put this for your last day revision. Now, Good Drugs and Pharma acquired a sachet filling machine on 1st April 11 for 60 lakhs. Okay, so this is, let us say, machine whose carrying value is what was acquired for 6 years. The machine is expected to have a life of 6 years. At the end of the financial year 11-12, the carrying amount was 41 lakhs. So for the machine, the carrying amount is 41 lakhs. A short circuit occurred in the financial year, but luckily the machine did not get badly damaged and was still in working order at the close of the year. So this is an indicator of impairment. The machine was expected to fetch 36 lakhs. So this is the net selling price, 36 lakhs if sold in the market. Okay. The machine by itself is not capable of generating cash flows, and hence the value in use for this machine cannot be calculated reliably. It is not, so I can't do impairment testing for the machine itself, and hence I need to go to the CGU level. Okay, however, the smallest group of assets comprising of this machine and is also capable of generating cash flows of 54 crores per annum and having a carrying amount of 3.46 crores. All such machines put together would fetch 4.44 crores if disposed. Discuss the applicability of impairment loss. So over here, if I look at the carrying value, this is 346 lakhs. Compare this 346 lakhs with the net selling price of 444, or value in use is 54 crores or 5,400 per annum. So minimum I can get 444, and hence is the CGU impaired? No. Let us say we don't know the exact value in use, but 54 crores per annum into whatever is the life discounted will give you. So maybe it will be more than 54 crores over the next 4-5 years, but nevertheless, even if that number is anything, 4.4 crores is obtained on selling the CGU, and hence there is no impairment at the CGU. Remember, if there is an impairment at the CGU, you will allocate the impairment in the ratio of the carrying value, but here if there is no impairment at the CGU level, there will be no allocation. So there will be no impairment loss, which will be even recorded for the sachet filling machine. For sachet filling machine, which is a part of the CGU, you will have to calculate the impairment loss, and that impairment loss cannot be directly calculated because the value in use is not possible. So you go to the CGU level, and at the CGU level you will compare the carrying value with the recoverable value. So over here, impairment loss, we will say that there will be no impairment loss. Now on similar lines, there is an example. After this, you should ideally refer question number 14, which is an example which we will come to, for which we will take these number scheme for reference. Okay, so let us review question number 9. 14 we will do in some time. Following details: find out the impairment loss, treatment of the impairment loss, current year depreciation, which is assumed to be after impairment. The particulars of the asset are given to you. So cost of the asset is 56, useful life, salvage value, current carrying value is given to you. Let us say at 27.3, useful life remaining is 3 years, recoverable amount is 12, and upward revaluation done in the last year. We'll assume that the same balance is appearing in the revaluation reserve still. So what do you have to find? Impairment loss, that is comparing carrying value of 27.3 minus the recoverable value, which is 12, and hence I think 15.3 is the impairment loss. Treatment of the impairment loss: out of the 15.3, you will first take the balance against the revaluation reserve, which is 14, and excess, if any, that is 1.3, which will go to the P&L. 14 will be adjusted against the revaluation. Current year depreciation: when you look at the current year depreciation, this would be after impairment. So 27.3 was there in your ledger, minus, you will recognize 15.3, your asset comes to 12, you divide it by 3 years, and hence this comes to 4 per annum. So this comes to, let us say, 4 per annum, which will be the depreciation. Okay, next you have question number 10. Let us review this based on the data which is there. We have put this for LDR because here that your impairment adjustments are also done. There is some revaluation adjustment as well. And what if your recoverable value becomes 0? Even that is tested. So it's a decent question. A plant was acquired 15 years ago at a cost of 5 crores. Its accumulated depreciation at the end of 31st March 11 was 4.15 crores, which means the carrying value on 31st March 11 would be 5 minus 4.15, which is 0.85 crores. Depreciation estimated for the year 11-12 is 25 lakhs. So you have calculated depreciation on whatever is the ledger balance. So that is 0.25 lakhs. So we were saying that the estimated depreciation is around 25 lakhs. So that must be on the balance that is there at the start of the year minus 25 lakhs is 0.25 crores, and hence your balance at the end on 31st March 2012 will be around 0.6. Estimated net selling price as on 31st March 11 was 30 lakhs, which is expected to decline by 20% at the end of the next financial year. So this is 30 lakhs minus 20% will come to around 24 lakhs or 0.24 crores. So institute has implicitly assumed over here that whatever is the impairment testing that is to be done on 31st March 2012. They could have done it on 31st March 11 as well because data is there, but institute has done all the working on 31st March 12, so we will also follow the same pattern. Its value in use has been computed 35 lakhs on 1st April 11, which is expected to decrease by 30%. So 35 lakhs minus 30% will come to probably 24.5 lakhs. Assuming that other conditions for applicability of the impairment accounting standard are satisfied, what should be the carrying amount of this plant as on 31st March 2012? So the carrying amount, second, how much will be the amount of write-off for the financial year 31st March 2012? So basically your carrying amount you have calculated as 0.6 crores. However, if I want to find the recoverable value, which is higher of the two, which is 24.5. Now 0.6 crores is nothing but 60 lakhs. So you will take 60 lakhs minus 24.5, which comes to what? 60 minus 24.5 comes to 35.5. So how much will be the write-off? Well, this will be 35.5 lakhs, and hence your carrying value would be 60 minus 35.5 will come to 24.5. This will be 24.5. If the plant had been revalued 10 years ago, the current revaluation reserve against this plant was 12 lakhs. What would be your answer? Well, generally this 35.5 would have gone to the P&L. However, if there was a balance in the revaluation reserve, then out of this 35.5, 12 will go to the revaluation reserve, and excess, let us say 23.5, will go to the P&L. The last, if the value in use was 0 and the enterprise was required to incur a cost of 2 lakhs to dispose the plant, institute over here ICAI has assumed that the net selling price would be a fair value of 0 minus 2, that is equal to minus 2. Now in my opinion, instead of 0, one can always assume that 24, which was a given net selling price, is taken. 24 minus 2, that is equal to 22. It can be done, but if it comes in the exam, it is best if you keep consistency with the institute solution, where in such a question they have said that if it was a value in use is 0 and if it had to be disposed of, it will be disposed of at a cost of 2. We will assume that there will be a 0 rupees, like the nuclear plant question 6 case, minus 2, and hence your answer comes to a negative 2. So over here your value in use is 0, net selling price is negative 2, so recoverable value is 0. Compare this with the carrying value of 60 lakhs, and hence the entire 60 lakhs will go to the impairment loss in the P&L. Would your response in 1 and 2 be different? Well, yes, your response will be different. Over here, as you can see, in the last case, this will be the entire book value of the plant will be written off and charged to the profit and loss account. So this takes care largely of all the practice questions as well as the illustrations in the institute material. 11, 12, 13, 14, 15 are 5 examples that the institute has, which we will discuss. So you will see most of these as cases which are actually examples. Question 11 on CGU. A mining enterprise owns a private railway to support its mining activities. Okay. The private railway can only be sold for scrap value, and the private railway does not generate cash flows from continuing use that are largely independent of the cash flows from other assets of the mine. So what will be the CGU? Will the railway and the other assets of the mine be separate CGUs, or will the railway plus other assets of a mine for other mine assets, will there be a single CGU? Sir, it will be a single CGU. Why? Because the question very clearly tells you that the railway does not generate cash flows which are independent of the other assets of the mine, and hence this will become a single CGU. So this will be a single CGU, that is a mine as a whole. Okay, next you go to question number 12. This is interesting. A bus company provides services under contract with a municipality that requires, ye important sentence hai, minimum service on each of the 5 separate routes. So there may be 5 buses which are operating on each of the 5 routes. Okay, but there is a minimum service requirement. I can't just operate on 4 routes and skip the 5th route. I have to operate on all the 5 or none of them. Assets devoted to each route and the cash flows from each route can be identified separately. Okay, so we will assume that each bus which is operating on each of these routes is capable of generating cash flows. I'm not saying independent cash flows. One of the routes operates as a significant loss, which means ideally there's an indicator of impairment on one of those buses where there is a significant loss. So ideally, should the impairment testing be done only for that one bus or for all the 5 buses together? Well, I can say that for that one bus, I can calculate what the carrying value, ledger balance of the bus is. I can find what is the net selling price of the bus, and I can even find the value in use. However, can I say that the profit on the first 4 buses is dependent on the loss of the 5th bus? The government might have clubbed this contract in such a way that if I want to generate profit on the first 4 buses, I'll also have to operate the 5th bus at a loss. And hence, can I say that the first 4 buses and the last bus, 5th bus, are independent or are they interdependent? Well, because of this line that I've highlighted, that there's a minimum service requirement, these seem to be interdependent, and if they are interdependent, then all the 5 buses together will be treated as a single CGU. Now, apart from this, there may be other 3 buses in another municipality. They will not be a part of my CGU, but these 5 buses generate cash flows, but these cash flows are interdependent, and hence I will treat this entire group of 5 buses as a single CGU. That is question number 12. Next, you go to question number 13. This is on site restoration. So this is AS10, AS29, all of these covered. So I would treat it as, if you have not done that, maybe this is a little complicated for you. A company operates a mine in a country where legislation requires that an owner must restore the site on completion of its mining operations. Okay, so there is a site restoration obligation. The cost of restoration includes replacement of the overburden, that is the soil which you must have removed, which must be removed before the mining operations commence. A provision for the cost to replace the overburden was recognized as soon as the overburden was removed. This is correct. The moment you remove the overburden, that is the soil, you are under an obligation to restore it, and hence that is correct that it is removed. The amount provided was recognized as a part of the cost of the mine and is being depreciated over the mine's useful life. Okay. The carrying amount for the provision for restoration is rupees 50 lakhs, which is equal to the present value of the restoration cost. So basically the relevant part is the provision for restoration cost appears at 50 lakhs in your books, which is by the way the same as the present value of cash flows as well. The enterprise is testing the mine for impairment. The CGU for the mine is the mine as a whole. Okay. The enterprise has received various offers to buy the mine at a price of around 80 lakhs. This price encompasses, that is, includes the fact that the buyer will take over the obligation to restore the overburden, which means 80 lakhs is paid for whom? Is it paid for the mine alone or mine along with the site restoration obligation? Sir, both. Disposal costs for the mine are negligible. The value in use of the mine is approximately 1 crore 20 lakhs, excluding site restoration costs. It is like saying that the cash flows excluding salvage value, but value in use is including salvage value. So you add it in question 1, question 2, etc. In a similar way, value in use should ideally be after considering all cash flows and not excluding any particular cash flow. So here site restoration cash flows are excluded, their cash outflows, they should be considered. The carrying amount of the mine is around 1 crore. So what do you have to find? Well, you have to find the impairment, in which case you will calculate the carrying value. Carrying value is 100 minus 50. This is important. That is equal to net 50. I can't compare 100 directly with 80 because the buyer is paying you not just for the asset, the buyer is paying you for taking over asset and liability both, and hence that 80 has to be compared with the ledger balance of asset and liability both. If I have to compare recoverable value, which is the higher of the net selling price, the net selling price is 80 for asset and liability both, or value in use, which is 120, but 120 is excluding restoration cost minus the present value of restoration cost, which is 50, which is the present value. So 120 minus 50 comes to, let us say, 70. You select whichever is higher, which is 80, and hence you will compare 50 with 80, and hence there is no impairment over here. So this is again there in the institute material. It's a little complicated. The important part over here is the carrying value of the CGU is 50 lakhs, which is the carrying value of the mine less the carrying value of the provision of 50 lakhs both. Okay, so that is something that you should practice. Next we go to question number 14. So we'll go to question number 14. I would take question number 8 as a numerical base for explaining question number 14. Again, this question is more like an example in the institute study material, so there are 2 assumptions. So we have broken it between a question and a solution, though in the institute you have a single flowing example. So we will discuss this, something similar to that. So let us review this along with question number 8. If you keep the numericals of question number 8 handy. So this was your question number 8, if you remember, where we had a machine with a carrying value and all of this data was given of 41, net selling price of 36, value in use was not available. So we went to the CGU level and we found that CGU there was no impairment. So similar to this, you have question number 14. A machine has suffered physical damage but is still working. In question 8, you had a sachet filling machine, same as that, although not as well as it used to. The net selling price of the machine is less than its carrying amount. So in that question, if you remember, the net selling price was 36, the carrying amount was 41. Now, ideally, I need to find the value in use for this machine. The machine does not generate independent cash flows from continuing use. So the value in use cannot be determined, which means I should ideally go to the CGU level, provided I'm interested in using the asset or possibly even selling the asset. I don't know. The smallest group of the assets that includes a machine generates cash flow from continuing use that are largely independent of the cash flow from the other assets is a production line to which the machine belongs to. The recoverable value, this is recoverable value, the recoverable value of the production line shows that the production line taken as a whole is not impaired. Like for example, if I were to look at question number 8 related data, in question number 8 there was a machine which has a carrying value of 36 lakhs. Its net selling price was around 41 lakhs. Value in use could not be determined. You compare that, because value in use cannot be determined, you compare it to the CGU in the cash generating unit. You had 3.46 crores or 346 lakhs worth of carrying value. The net selling price was around 444 lakhs, that is 4.44 crores, and you had some value in use which was 54 crores per annum. So basically we were saying that there is no impairment in the CGU. If there is no impairment in the CGU, there is no impairment in the individual asset. I will not allocate impairment loss. So there are two assumptions. So institute over here says assumption 1, that there is no intention to replace the machine. If nothing is given, that is your standard assumption, no intention to replace the machine. So you, even if the machine is operating at a lower capacity, you intend to continue to use the machine. And the new part is assumption 2. In assumption 2, you have been given that the management is committed to replace the machine. Now this is the new part in my understanding. So when I look at assumption 1, this is similar to question 8 only. I will say that if there is a possibility that I can continue to use the machine or I can even sell the machine, that is implicit assumption, in which case I will consider the impairment at the CGU level. So in assumption 1, let's say there is no commitment to replace the machine, in which case I will do impairment testing at the CGU level. Why? Because I may use the machine or I can sell it. So if I use the machine, I don't know what is the cash flow that the machine individually generates, and hence I go to the CGU. So over here, as you can see, the production line is not impaired, therefore no impairment loss is recognized for the machine. This is for assumption 1. Assumption 2 is the new part. Budgets or forecasts approved by the management show a commitment of the management to replace the machine. If the management wants to replace the machine, then that implicitly means that the management is not intending to use the machine. If they don't intend to use the machine, then it is not that the value in use is not determinable. The value in use will be nil, or in that case negligible. I'm not going to use it. If I'm not going to use it, by the way, I'm going to sell it. And if I'm going to sell it, then what will be my calculations? Well, my machine will then recover the net selling price only. So in this case, you can do the impairment testing for the machine itself, and you need not go to the CGU level. Sir, how will we know? Well, if the question does not tell you anything, we will assume that the machine can either be used or it can be sold. But if the question very categorically tells you that we intend to sell the machine, in which case, if we intend to sell the machine, well, we are not going to use it, and hence the machine can recover maximum 36x because it can't be used. So over here, since the machine's net selling price is less than the carrying amount, impairment loss is recognized for the machine in this particular case. So this is a theory case in your study material in case you want to replace the machine. Question number 15 is an important question from last day revision perspective, also an example from the institute's perspective. So here we have not had a separate question answer type of a thing. We have done it the way institute's example appears. So over here, let's review. At the end of 2010, Enterprise M acquires 100% of Enterprise Z for 3000 lakhs. Okay, so that is your purchase consideration. Z has 3 cash generating units, A, B and C. Let's say 3 divisions. with net fair values of 1200, 800 and 400 lakhs respectively. So if I total this up, this comes to probably 2400. So for something which is worth uh, 2400, the company is paying 3000. M recognizes goodwill of 600. So the difference between the two, that is 600, is a goodwill. That is 3000 minus 2400, which relates to Z, which is perfect. At the end of 2014, now when did all of these transactions happen? Sir, they happened around, I think, 2010. So maybe 4 or 5 years later, at the end of 2014, A makes significant losses. A is one of the divisions. Its recoverable amount is estimated to be rupees 1350 lakhs. The carrying amount is detailed as below. So you have net carrying amount of A, B and C, and then there is a separate carrying amount of goodwill. Now the problem is, this goodwill is paid for Z as a whole, which has 3 divisions. So I'll have to reasonably allocate the goodwill to division A, division B and division C, because as an indicator of impairment on A. Scenario A, goodwill can be allocated on a reasonable and a consistent basis. Now what will be the reasonable basis? Well, goodwill was created at the acquisition date. Now at the acquisition date, A, B and C had values of 1200, 800 and 400 respectively, and hence ideally whatever is a goodwill should be allocated in the ratio of 12 is to 8 is to 4, that is 3 is to 2 is to 1 probably. This is your appropriate ratio of allocation. So if I have to allocate goodwill today, I will allocate the 120 that is there today in the ratio of 3 is to 2 is to 1. Now basically 120 divided by 6 into 3, that comes to around 60 rupees is attributable to A. B and C also there will be something or the other attributed. So this is 120 divided by 6 into 2, maybe 40 is attributable to B, maybe 20 of this goodwill is attributable to C, but impairment indicator is existing only in A, and hence you will do the workings only for A. So for A, the carrying value including goodwill is 1360. You compare it with the recoverable value of 1350, so 1360 minus 1350, which is the recoverable value, 10 rupees, and this 10 rupees will first be attributable to goodwill. Now out of the 60 which is allocated to A, 10 rupees will be deducted. So over here, if I go to C, 1360 is attributable to A in accordance with, they call this as bottom up test, that is a smaller CGU. M compares the recoverable value to the carrying amount, and hence there is a 10 rupee goodwill. Impairment loss of 10 is fully allocated to goodwill in accordance with AS 28. Now the second case is a new case, where what if the goodwill cannot be allocated on a reasonable and consistent basis? Now Zabardast, you can't allocate 3 to 2 to 1. The question very clearly tells you it is not allocable. Well, if it is not allocable, then what will you do? Well, as per the standard, if it is not allocable, then you will have to do 2 testings, one for bottom, that is a smaller CGU, and then for top, that is a larger CGU. So over here I will do the smaller CGU impairment testing, where I have only A whose carrying value is 1300 compared to the recoverable value of 1350, and hence there is no impairment of A, and hence A will continue to operate at 1300 only. For B and for C, well, I don't have the recoverable value separately available, so B will continue to be at 1200, C will continue to be at 800, but apart from this, I will also allocate goodwill to the company as a whole. So if I want to allocate it to Z Limited as a whole, 120 of goodwill will also be attributed. So 1300 plus 1200 plus 800 plus 120. So this is coming to 3420. So this is your total carrying value for Z Limited as a whole. If I read further, there is no reasonable way to allocate the goodwill to A, B and C. At the end of 2014, Z, that is the entire company, recoverable value is estimated to be 3400. So I'll compare this with the recoverable value, which is 3400, and hence there is a further 20 rupees which is impairment. Now impairment will be debited to P&L, impairment loss account debit, but what will I credit? Sir, I will credit goodwill. So M applies bottom up test, that is smaller CGUs, it compares A's recoverable value to the carrying value excluding goodwill, because I can't allocate, and hence there is no impairment loss. Further, there is no other impairment loss for everyone else as well, and hence I will do the top down test, that is for the company as a whole, where I would say 3420 is the total carrying value, compared it with 3400, so 20 rupees is the impairment loss which will be allocated to goodwill as per AS 28. Now this is where ICAI SM ends. If I look at the ICAI study material from question 1 all the way up, I think up to question number 10 or so, you had questions from the practice as well as illustrations. Then from 11, 12, 13, 14, 15, these were 5 questions which were examples in the study material. Now 16 to 19, I would say, are extra questions that we have borrowed from final CA for certain concepts which were not as extensively and properly done in the example side or the numerical side of your CA Inter. Institute has given you theory for these, but they have not given you sums. So in case sums come, you should be aware. So 16, 17, 18, 19, if you can crack it, well and good. Otherwise, just have a broad understanding and proceed. This is not from your institute CA Inter material, but we are doing some extra workings so that you are getting a grip on concepts like reversal of impairment loss, which was not done as extensively in CA Inter. At least on the numerical side, you have the theory, at least in CA Inter as well as something like top-down, bottom-up test with allocable as well as unallocable corporate assets. Again, whose theory is there, but numerical sums are not there. So we have borrowed a few questions. We'll try to touch upon that quickly. If you understand it, great. If not, if you are running out of time, then you skip it, pray to God, and you proceed with whatever is the sums which are there in your Inter material, and I think that should suffice. But nevertheless, for a holistic and a better and a deeper understanding, that is why we give a caveat that if you are running out of time, you can probably skip the remaining part of the video. If you want to have a deeper understanding and you want to be equipped for a tough paper, if it comes something like this, institute can very well ask you, then you kind of run through the remaining part of the video as well. Okay, let us go to question number 16. This is on reversal of impairment. Remember, if you want to reverse impairment loss, reversal of impairment can only be done to the extent your carrying value had there been no impairment. You can't go beyond that. So basically the steps that we follow over here, if you review the steps that we follow over here for reversal of impairment, as you can see over here, is when can you reverse impairment? Well, reversal of impairment loss can happen if there's an improvement in potential of the asset, you can reverse. But when you reverse it, you can't blindly reverse whatever was the impairment charge. So at the time of reversal, you will calculate the carrying value of the asset ignoring impairment. Had there been no impairment, what would be the carrying value? Second, merely because the carrying value is a particular number, you can't take it up to that. The asset should be capable of recovering that. So you compare the recoverable value on the date of reversal. Now you can reverse, that is the maximum limit, up to the lower of the carrying value or the recoverable value. So if your carrying value had there be no impairment is 60, the recoverable value is, let us say, 70, I can maximum take it up to 60. Take it means what? Well, I can maximum go up to 60, calculate the ledger balance of the asset on the date of reversal. Let's say the asset is currently appearing at 45, which means the reversal will be, currently the ledger is at 45, you can take it all the way up, uplift it up to 60, and hence 15 will be the reversal. So institute has given you some theory on this, but they have not given you sums. So in case it comes, we will practice question number 16 on these lines, applying those 5 steps. Remember, the reversal can happen in any asset. However, for reversal to happen for goodwill, the impairment should have happened due to an external factor, and now that same external factor, like a legal ban, is lifted, should have reversed. Again, for goodwill, AS 14 applies, and as per AS 14, goodwill has to be amortized over a maximum 5 years. So like intangibles with an indefinite life, you maximum amortize it over 10 years. In a similar way, goodwill, you will study under amalgamation, has to be amortized over a maximum period of 5 years. So keeping that into consideration, we will go to question number 16. H is in the business of manufacturing and exporting of a product. Sometime back in 2018, the government put restriction on export of goods exported by H. So that is an indicator of impairment. This is happening in 2018, and due to that restriction, H impaired its assets. H had acquired some identifiable assets worth 4,000 for 6,000 lakhs, which means that 2,000 extra must be paid for goodwill. At the end of 2014, around 4 years back, the difference is treated as goodwill. Perfect. So over here, you had certain assets which are worth 4,000 and goodwill worth 2,000, which was acquired 4 years back. The useful life of the identifiable assets is 15 years and depreciated on a straight line basis. Okay, goodwill, unless given otherwise, will have a maximum 5-year life. When the government puts restriction at the end of 2018, the company recognized an impairment loss by determining the recoverable value of the asset at 2720 lakhs. Now there is absolutely nothing new over here. If I go to see, there are certain assets and there is some goodwill as well. So on a total basis, if I look at the cash generating unit consisting of assets and goodwill both, the carrying value, well, I start at 2014 end. At 2014 end, the assets were worth 4,000, goodwill was worth 2,000. On this, you will charge some depreciation or amortization as the case may be. So over here, this will be 4,000 divided by 15 into 4 years have gone by. So 4000 divided by 15 into 4 comes to around 1067. And goodwill 2000 divided by 5 again into 4 years have gone by. So this must be 1600. So basically the carrying value at 2018 end would be around 2933 and 400. So total would be 3333. At this point, the recoverable value of the entire cash generating unit is given to you as 2720, and hence there's an impairment of 3333 minus 2720 comes to around 613, and hence the impairment over here will first be recognized against the goodwill. So 613 minus over here will first go against goodwill 400, and excess, that is 213, will go against, sorry, goodwill is over here, so we'll just have to interchange this. 400 will be adjusted against goodwill and 213 will be adjusted against other assets. So over here, after doing all of this working, your goodwill will become 0. So if I want to find the revised carrying value, this would be 400 minus 400, this comes to 0, whereas over here this will be 2720. So this is the revised carrying value at 2018 end. This is nothing new over here. In 2020, now is the new part. In 2020, the government lifted a restriction imposed on the export, and due to this favorable change, H re-estimated the recoverable amount, which was 3420 lakhs. You are required to calculate and allocate impairment loss in 2018, which we have already done, and reversal of impairment loss as per AS 28. So if I go to see in the year 2020, first I will see goodwill. What are the steps? I first need to find the carrying value. Had there been no impairment? Now for the assets in general, had there been no impairment, my assets were 2933. Out of 15 years, 11 years, 4 years had gone by, 11 years were remaining, out of which another 2 years from 18 to 20. So this is 2933 divided by 11 into 2, that is around 533 of depreciation. So over here, these assets which were now earlier at 2933 minus this will now appear at around 2400. 2933 minus 533 comes to 2400. When I go to goodwill on the other hand, remember goodwill which was at 400, it would have been fully amortized because there was only 1 year remaining, and hence goodwill would be 0. So for goodwill we don't need to even check for anything, because goodwill, had there been no impairment as well, I would have continued to 2019, the goodwill would have been become 0, and hence now in 2020 I can't create a goodwill which would have become 0 in any case had there been no impairment. I will compare this with the recoverable value. So the total recoverable value now is going to be compared. So this is 3420 will be compared with the other assets, and hence your maximum balance after considering the reversal, if any, would be the lower of these two, that is 2400. I can't go beyond 2400, otherwise it will become a upward revaluation. I'll compare it with the actual balance in my ledger. In my ledger, actually, there was an impairment, and hence the assets came down to 2720, I think. 2720 minus, you will have 2720 divided by 11 into 2 years must have gone by. 2720 divided by 11 into 2 comes to around 495, and you will have approximately 2225 in your ledger, which means you can reverse the impairment loss. Your reversal can happen, so you can go up to 2400 maximum. Currently in your ledger you are at 2225, and hence your maximum reversal will be around 175. Goodwill, there cannot be any reversal. It may be due to an external event, and that same event is reversing. However, I cannot reverse impairment because my carrying value of the goodwill, had there been no impairment, would be 0. So the maximum ledger balance after impairment will also be 0. Okay, so that kind of takes care of question number 17. Now this is a slightly tricky question, I would say. Okay, there is, I think, something else appearing over here. There is a slightly tricky question over here. This is question number 16. The reversal part, I would say, is a new part where you might need some understanding. Next, you go to question number 17. This is regarding allocation of corporate assets. Remember, corporate assets will be allocated to each CGU if they are allocable in the ratio of their carrying values. What is the logic behind that? The bigger the CGU, more is the corporate asset, like a research and development center, training center, that can be utilized. Smaller the CGU, lesser will be the utilization of that common corporate asset. Corporate assets are like a research and development center, training centers, etc., which don't generate cash flows themselves, but along with other operating assets, they are capable of generating cash flow. Now, it is again possible that some of these assets are allocable and you will allocate in the ratio of carrying value. However, it is very much possible that you are also given the useful life. Remember, the problem over here is if there are assets which have a longer useful life, they will utilize the corporate asset more. So if there's a division which will survive for 30 years, maybe it's a small division, but it will utilize the corporate asset more for the longer number of years. There's another asset, let's say asset CGUC, which is utilizing the CGU corporate asset for lesser years. It may be big, but it is utilizing for lesser years. So the reasonable basis over here, at least what the institute does, even at final CA, is they consider both the life and the carrying value. For allocating the corporate asset, they consider the life of the CGU as well as the carrying value of the CGU and the product of the two. Considering both of them, they determine the reasonable basis. Well, if the life is not given, we can allocate directly based on the, if life is not given, you can allocate directly based on the carrying value. Okay, this is for allocable. For unallocable, you will again do bottom up, that is the smaller CGU, and then do top down, where you will look at the company as a whole and see if there is any impairment over there. So this is for this special case over here. On allocation ratio for corporate assets, we say allocation ratio is a time based weighted average carrying values, and unallocable corporate assets or unallocable goodwill as well over here. So a detailed application for this concept is done in question 17. Now, M Limited has 3 cash generating units A, B and C. Due to adverse changes in technological environment, M conducted impairment test of each of the CGUs. On 31st March 18, the carrying value of A, B, C are 100, 150 as well as 200 respectively. This is for A, B and C. The operations are conducted from a headquarter and the carrying amount of the headquarter assets, all the headquarter assets are 200 lakhs, which comprise of a headquarter building of 150 lakhs and a research center of 50 lakhs. So 200 lakhs is corporate assets which comprise of 150 of a headquarter building and 50 of a research center. The relative carrying amounts of the cash generating units, you will add over here the relative carrying amounts, you can say time or life adjusted into bracket life adjusted. This is what the institute has also done. We should also do that. Are a reasonable indication of the proportion of the headquarter building devoted to the cash generating unit. This is only for the headquarter building. The carrying amount of the research center cannot be allocated on a reasonable basis to the individual units. Very clearly told. Following are the remaining useful lives of A, B and C and also the headquarter asset. The headquarter assets are depreciated on a straight line basis. The recoverable amount of each cash generating unit is based on the value in use. Since net selling price cannot be calculated, that is fine. The value in use is equal to, you have been given the value in use numbers for A, B and C and then M as a whole, which is higher than the total of these three. The research center generates additional future cash flows for the enterprise as a whole and hence maybe M Limited as a whole has a higher value. Therefore, the sum of the value in use of each individual CGUs is less than the value in use for the business as a whole. The additional cash flows are not attributable to the headquarter building. Calculate and show the impairment loss as per AS 28. Ignore the tax effect. So when we do the workings over here, what do we get? So if we go to question number 18, I will first try to allocate the corporate asset to each of the cash generating units. So your corporate asset comprises of a headquarter building, that is 150. It has to be allocated to what? To A, B and C. It is allocable. In what ratio will you allocate? Well, for A, your carrying value I think is 100, 150 and 200. 100 for B, 150 and for C 200. And you have to also look at the life. The life over here is I think 10, 20 and 20. So into 10 into 20 into 20. So A is a smaller CGU, so it has lesser allocation. It also has a smaller life and hence it has a relatively lesser allocation. 1000, this is 3000 and this is 4000. So probably the ratio would be 1:3:4. So this 150 will be allocated as, let's say, 150 divided by 8. This is 18.75 going to A into 3, probably 56.25 going, and C mein 75 is going. So this is your allocation. So if I were to calculate for A, B and C, I will say that your carrying values comprised of the carrying value of the individual assets, that is 100, plus 18.75 for the corporate assets, this is 118.75. This includes, let us say, 150 plus 56.25, that is equal to 206.25, and for C 200 plus 75, this is equal to 275, and hence you will compare the recoverable value. So if I were to compare this with the recoverable value, my recoverable value will be given to me, this is 199, and hence there is no impairment. For impairment, my recoverable value should be lower. Over here this is 199, second case this is 164. Acha, so here there would be an impairment. So this is 206.25 minus 164, and this comes to 42.25 का overall impairment loss. And last May, this is coming to what, 271 or something, and hence there is an impairment loss of 4 rupees. Now remember, where will you allocate this impairment? You will allocate it proportionately between the individual assets and the corporate assets. If there was goodwill, you allocate first to goodwill, but there is no goodwill. So this is your impairment loss. Now, top down, when I go to M as a whole, M has A, M has B, M has C. A is worth 118.75 including the corporate asset. There is no impairment for A. B was worth 206.25 minus 42.25. 206 के अंदर headquarter building is already there. So this comes to 164. C was at 275 minus 4, this comes to 274. Now will I add the headquarter building again? The answer is no, because when I take 118, 206 as well as 275, I have taken the headquarter building, and when I take these impairment losses, I have taken the impairment losses for the headquarter building as well, so it is implicitly added. But then the research and development center, have I considered it? No. Shall add it separately, and hence if I total up 118.75 plus 164 plus 274 plus 50, this comes to around 606.75. This is the carrying value for the company as a whole. You compare it with the recoverable value of 720, that is company as a whole, and hence there is no impairment. By the way, if there was an impairment, like for example, if this was not 606, this was, let us say, 750, then there would be a 30 rupees impairment. Ideally, the 30 would be allocated to A, B, C and the R&D center. But A, B and C would say that we are already at the lower of the carrying values or recoverable values, we will not bear any impairment loss. And if there was an impairment, it had to be borne by the R&D center only. This is just for our understanding in case it comes up, and final CMA, it has come up a lot of times. So if institute wants to play around, this can be a very good exam question which they love asking you. So over here, as you can see over here at the end, since recoverable value is more than the carrying value, no additional impairment loss has to be recorded under the top down test. Only impairment loss of 46 lakhs will be recorded as a result of bottom up test. So how is 46 lakhs calculated? Approximately 42 plus 4, that is 46 lakhs of impairment loss. Okay, so this is question number 18. I would put this as important. Question number 19, I'm not really important. It's more of a case based question on determination of cash generating units. And 19, so we have already kind of covered sums similar to that. So 19, there's nothing new per se. In 18, I have to identify a CGU. Now, how is a CGU defined? CGU is defined as a group of assets, smallest group of assets which are capable of generating a largely independent cash flows. Capable of, what is capacity? Let us say if there is an existence of an active market for our products, is capacity to generate independent cash flow. Like for example, we have discussed, let us say there is a company like Tata Steel, it has two assets, one is a mine, one is a refinery. The mine generates iron ore. Now iron ore as a market, so the mine itself is capable of generating cash flows, but the mine is not selling the iron ore in the market, it is giving whatever is the iron ore to the refinery. But is the mine having the capacity to generate an independent cash flows? Yes. And hence, since there is an active market, mine is a separate cash flow, refinery can also generate a separate cash flow. Even if the mine is not there, they can go to the market and buy the iron ore. However, if the mine is generating an asset which has no market, then for mine to generate a cash flow, it needs a refinery. For refinery to make its goods, it needs a mine. And hence, they are a part of a single CGU. So, the existence of active market is an important thing. So, if there exists an active market, you can say that I don't depend on anyone else and I can be my own CGU. But if there is no active market, then I am depending on someone, and hence together we make a CGU. On the other hand, another thing is, let's say I'm an output manufacturing company. I'm manufacturing motorbikes in India. I'm manufacturing motorbikes in Brazil. Now, India and Brazil are very far away, and hence I evaluate capacity separately. It is possible that the Indian market does exceptionally well. Brazilian market, no one is buying my bikes. Well, there's an indicator of impairment on the Brazilian factory. two separate CGUs. Capacity is viewed independently, separately. However, there are two factories in India only, or one in India, one in Bangladesh. Now, if the Bangladesh market is not doing well, still I can use these bikes manufactured in Bangladesh to sell it to India or vice versa. In which case, my capacity is a combined capacity, in which case plant 2 and 3 are dependent on each other. So, if I look at output bearing companies, I'll see that whether I'm looking at capacity on a combined basis or on separate basis. In my first example, I'm looking at 100 units capacity in India separately, 50 in Brazil separately. In the second example, I'm looking at the total overall 150 capacity. Wherever the output is, demand is, I can use 100 as well as 150 both. So they are dependent on each other in the second case. In the first case, they are independent of each other. Okay, let us review question 18. It's a complex question, I would say, but a case-based one. M produced a single product and owns plants A, B and C. Each plant is located in a different continent. Plant A produces a component that is assembled either in plant B or C. Like plant A is making an engine which can be used by B or C. The combined capacity of B and C is not fully utilized. So the management is evaluating capacity of B and C on a combined basis. So B and C together are evaluated. M's products are sold worldwide from either plant B or C, that is plant B's production can be sold in plant C's continent, if products can be delivered faster from plant B and vice versa. Utilization of plant B's and C's depend on the allocation of sales between the two sides. All of this is a little subjective, but they show that B and C are interdependent on each other. It is very much possible that the capacity of C can be utilized by B's demand or vice versa. So B and C are dependent. What is the question telling you? For each of the following cases, what are the cash generating units for plants A, B and C? There is an active market for plant A's products. Then A is a separate CGU and then B and C together. So there will be two CGUs. But if there is no active market for A's products, then A is dependent on B and C are also dependent on A, and hence there is a single CGU that is comprising of A, B and C together. So basically, from an exam perspective or an MCQ perspective, just in case this crops up, over here one can say that if there is an active market, then A itself can be a CGU. If there is no active market, A is dependent on B and C are also dependent on A, and hence there is a single CGU. Okay, this is question number 18. So a little taxing these questions, but having some understanding gives you a little more clarity, I believe. And last is 19. There's nothing new over here. You can just quickly scan through this. C and S. C acquired S, who is a CGU on 31st March 16 for 8,000 lakhs. The details of acquisition are as under. Fair value of the assets are 6,000. For something worth 6,000, you are paying 8,000. So the goodwill will be 2,000. Okay. The anticipated life of the acquired asset is 5 years and goodwill is to be amortized over 4 years. So that is given to us. C uses the SLM method for depreciation. On 31st March 18, C estimated the significant decline due to change in the government policies. The net selling price of the asset is not determinable and the cash flow forecast based on recent budget of the next 7 years, considering the change in policies, are as follows. Incremental cost of financing is 8%, so that is a discount factor which represents the current market assessment of time value of money. So you have all of these numbers over here. You are required to calculate the value in use, impairment loss and revised carrying value as on 31st March 2018. So what will we do? We will first try to find the value in use. This is the present value of 800, 800, 800, 600, 600, 500 and 500. This is going to be discounted at the rate of, I think, discounted at the rate of 8%. So I will do this calculation and come to 3459.4. This is my value in use. I'll compare this with the carrying value. Now, when did I acquire all of this? 31st March 16. So 2 years have gone by. So over here, 6,000 minus 6,000 divided by 5 into 2. So 6,000 divided by 5 into 2. This is 2,400. So 3,600 will be there in my assets. And goodwill made 2,000 divided by 4 into 2, which is another 1,000 will be there in goodwill. So this is 4,600. You compare 4,600 with 3459.4 and you get 1140. So 1140.6 lakhs. Okay, and the revised carrying value, well, out of this 1140, I will allocate first the entire amount to goodwill. So your goodwill will now be 0, 1000 minus 1000. And for the other assets which are currently at 3600, इसमें से अपन less करेंगे 140 excess 0.6. 3600 minus 140.6 and you get 3459.4. So if I go to see over here, I will see 3459.4 for other assets and 0 for goodwill. So this kind of takes care of the questions of AS28 as well. I hope you have got the much needed clarity. From an exam perspective, I would strongly recommend focusing on your first page over here. Most of the questions will come from this section, and most of these questions are there from question 1 up to question 9. Most of these questions that we did. Yes, if you want a holistic understanding, obviously you go to the other parts. Institute has given you some theory based questions on cash generating unit. We can just review that for an MCQ or a small case that can come up. And for other things like reversal of impairment or this allocation of impairment loss, top down bottom up approach, you might refer to extra questions for a detailed understanding. So I hope AS28 is a little more clear. The important questions we have marked out over here for last day revision, which are from question 1 to 15 only. The other questions which are extra, we have just put in as extra for a good to know and understand perspective. Okay, so that should be it. We will meet soon with another standard. Study well and bye bye. See you soon.